IFRS 18 is reshaping financial statement presentation globally, with a mandatory effective date for annual periods beginning on or after January 1st, 2027. This represents the first major change to income statement structure in decades. Today, we'll dive deep into what this means for your organization, particularly in the UAE and GCC region, and how AI is simplifying this complex transition for CFOs and accounting teams. So, who should follow these new standards? IFRS 18 applies to all entities that prepare financial statements in accordance with IFRS accounting standards. This is particularly critical for listed companies in the UAE and GCC, as well as financial institutions and large conglomerates that need to provide high levels of transparency to global investors. If your organization reports under IFRS, this transition is mandatory, and the time to start planning your data and systems alignment is now. The core philosophy is to reduce diversity in reporting and provide a more structured approach to performance. In the GCC, where reporting maturity is accelerating alongside initiatives like UAE Corporate Tax and Saudi Vision 2030, this standardization is crucial. IFRS 18 introduces standardized categories and subtotals, ensuring that every stakeholder gets a clear, comparable view of a company's true operating results, regardless of their industry or location. The biggest shift is the mandatory classification of income and expenses into three distinct categories: operating, investing, and financing. The operating category is now the default for items that don't fit elsewhere, providing a more consistent operating profit subtotal. This forces a higher level of discipline in how management categorizes business activities, ensuring every line item is mapped to the correct strategic bucket. While the operating category is the anchor, the investing and financing categories bring much-needed clarity to non-core activities. This clear separation allows investors to analyze an organization's core business performance without the noise of unrelated investment gains or interest rates. For capital-intensive industries in the Middle East, this distinction is a vital step toward better asset valuation and risk assessment. IFRS 18 formalizes management-defined performance measures, or MPMs. These are subtotals companies use in public communications outside of financial statements. Now, these measures must be included in a single note within the audited financial statements, accompanied by a reconciliation to the most directly comparable IFRS subtotal. This move brings non-GAAP measures into the light of audit and transparency. Companies must now provide more detail about items currently grouped together as other or miscellaneous. If an item is material, it must be presented separately. This ensures that the income statement remains uncluttered while the notes provide necessary granularity. For complex conglomerates, this means a significant increase in the volume of data that must be carefully managed and disclosed via automated reporting tools. Technically, this goes far beyond a simple accounting change. Organizations will need to fundamentally redesign their ERP mappings, reporting structures, and chart of accounts. It requires looking at how data is captured at the source to ensure it can be automatically classified into the new IFRS 18 categories. For GCC firms already undergoing digital transformation, this is an opportune moment to integrate AI-driven automation into their reporting frameworks. This transition should be viewed as a strategic finance transformation rather than a mere compliance checkbox. It's an opportunity to clean up legacy reporting silos and implement more robust data governance. By aligning your management reporting with the new categories, you can ensure a single version of the truth that satisfies both internal strategic needs and external compliance requirements. This is where AI becomes a game changer. AI-powered finance solutions can now automate IFRS 18 classifications by analyzing transaction descriptions and historical patterns. AI can handle the complex variance analysis and disclosure preparation that used to take teams weeks, completing it in a fraction of the time with near-perfect accuracy. This significantly reduces the risk of human error and allows finance teams to focus on strategy. At Acclancer, we've developed a solution specifically tailored for this transition. Our IFRS 18 automated dashboard, the IFRS 18 Intellect Expert chatbot, is designed to support finance professionals with intelligent reporting, automated classifications, and real-time AI synchronization. It bridges the gap between raw ERP data and compliant financial statements, providing executive-level analytics that help you not just report the past, but predict the future. A successful implementation follows a clear roadmap. Starting with impact assessments now is critical, as you will need comparative data for 2026 before the mandatory January 2027 go-live. A critical step is the dry run phase, where you report under both standards to ensure consistency. With Acclancer, this process is streamlined and monitored in real time, ensuring a smooth transition for the mandatory reporting periods ahead.